Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, Jan 29th, just after the close. First month of 2021 in the books. S&P finish up down about 0.5%. Let's call the NASDAQ up 0.5%, maybe 1% on the month. When you look at that, you would think it was a fairly mild, quiet month. A lot of headlines, a lot of trading headlines over the last week, 10 days, 14 days. You know, often we talk about a phrase we use, something we reiterate over and over, and that is understand what can go right with your position or the markets, understand what can go wrong. When you take your eye off of either of those scenarios, your performance tends to wane. Now, poor performance and blown up performance are two different things. And we saw it in spades this week with supposedly keen hedge funds with a real focus on risk-adjusted returns blowing up. And why did they blow up? Their own fault. Can't complain to anybody but themselves when you are short names that are 50, 60, 70, 80, 90% short of the float outstanding. Remember what a short position is, just to bring us all back down to that same platform. It's just the reverse of buying a stock and selling a stock. It's the reverse order. You're selling a stock, you're selling a borrowed stock with the hope that you can buy it and replace that stock at a lower price. Well, as that price goes higher, you start to run into higher costs on it, and very often calls from where you borrowed that stock to replace it, which turns you into a buyer and thus creates momentum in the names. Now, if you're short and have a short book that you're managing, one of the keen points is to understand who is in the position with you. And when you're looking at a position book and a quarterly report of securities owned by other funds, and you see multiple names large on the short side with you, and that doesn't ring a bell, shame on you. So, you know, the market is a beautiful, beautiful gauge of who ignores risk. Because sooner or later, the person that ignores risk gets carried out. And you saw it this week. Now, the other side, in terms of pressing bets, that's the market. If you're making money on the upside, you're making money on the upside. It's not your fault that the people on the other side of the trade ignored risk. So in terms of understanding positions, understanding risk, we saw a great learning lesson, a great lesson this week in what happens when your ego outstrips your ability to control risk or even analyze risk. And we'll see where some of these names go next week. What did Cumberland? Was Cumberland affected in any of the strategies? Not really. Markets were a little weak this week, down 2.5%, 3%. Again, as I'll repeat, coming off fourth quarter, a reset is very, very natural. What are some of the things we did this week? Sat on our hands in U.S. equity. In terms of U.S. equity, I had more than a couple. I had a bunch of emails asking me to give a better description of a term I used, a phrase I used last week, that the ducks were quacking, so we fed them. Let me reverse back to last week. We sold a little TAN, T-A-N. That's a solar energy ETF made up heavily of semiconductor stocks. Our initial position in that was in the 30s. We had been adding to it as the stock moved. The stock was $120, $121. All you could read anywhere was solar energy, Joe Biden, solar energy, solar energy. The buyers were coming in every day, moving TAN up, 2 points, 3 points, 2%, 3%. That's what we call ducks quacking. And when the ducks are quacking that loud, you have to feed them a little. That's just a trading phrase that's as old as the hills. I grew up on it in the mid-90s. So that's what we did last week. Now, oftentimes we'll do that and the security goes higher and we half kick ourselves. Not really, because risk control is so important. This week, TAN was down 11–12%. So did that trade, taking us from a 7–8% position in U.S. equity down to 5%, that trade looks good right now. We'll see if we reload on any further weakness. Where else do we see some weakness in the portfolios? Across the board, nothing too egregious, but we did add in some under-positioned JP Morgan in tactical trend. JP Morgan, 142, 143 2 weeks ago, pulled back into this 128 level today. For newer accounts and for accounts that were partial positions, we filled those positions out. So we want to take advantage of strong names on weakness. Tactical trend, we'll be looking very closely at adding to Microsoft on any further weakness. Loved everything about what they reported this week. One thing to keep in mind, we've heard a little bit of whispers out of, let's just say, the media about systemic risk in terms of what we're seeing trading day to day. A couple of things we keep an eye on that doesn't have us overly concerned in terms of the delivery of securities and the risk to broker-dealers and banks. Balance sheet of banks, balance sheet of broker-dealers, never been stronger. They have too much cash. They don't know what to do with the cash, number one. Number two, keep an eye on that 10-year Treasury. What is the 10-year Treasury? What is the 30-year Treasury? They are a risk security. When there's true risk in the market and fear in the market, securities away from Treasuries get liquidated and Treasuries get bought. So Treasury yields sink. Obviously, demand pushes yields down. What did we see this week? We saw a stable 10-year in the 102, 103 area actually move higher to 107 today. So at first blush, it would tell me as a trader who looks at cross assets that there isn't too much real danger out there in terms of systemic risk to any financials. Have a great weekend. I hope everything works out in terms of next week's trading. Keep your head on straight and understand risk and reward.
Good afternoon. I'm John Mousseau. I'm the President, CEO, and Director of Fixed Income here at Cumberland Advisors. It's Friday afternoon on January 29th. Quiet week in the bond market. 10-year bond moved a tick 109 to 108. 30-year bond moved down, 185 to 184. Some noise around there, maybe 5–6 basis points, but not much movement. Municipal bond yields down about 6 basis points. 10-year AAA scale down to about 0.71. 30-year AAA scale down to about 138, significantly below Treasuries. This tells you a couple of things. One, when you look at it in the light of the stock market being off, and a lot of it, as my colleague Matt talked about, with all the consternation about small stocks, bond market didn't pay any attention to that, which tells you it's kind of like business as usual. Looks like the economy's getting a little better. Initial jobless claims were down from expectations, 847 versus an 875, 900,000 last week. So that's a good sign. On the muni side, with yields down 5 or 6 basis points on scales, tells you lots of demand for bond deals when they come. Lots of inflows, consistent inflows, a little under $3 billion into municipal bond funds. That's picked up again. I think what people are smelling is probably a tax hike coming down. And they are looking at it not so much as the lower level of yields, which we have, but more of like, we want to be in this asset class of municipal bonds. We think this will continue to run, like most things, until you actually get a tax bill. But we think that for now, certainly that's the way the market is leaning. Next week, we're going to get the employment numbers. We're going to be looking at that significantly. And as we go forward, again, our view is you're going to see a spending bill, you're going to see an aid bill, whether it's $2 trillion or something lower than that, we will see. That will be hashed out by Congress. But there's no question there's more of that coming. So we think the market's expectations are for some additional spending, and down the road, if not necessarily inflation right away, some higher inflation expectations. So we'll watch the markets, and we'll be back to see you next week. Thanks.